Tonight I'll be speaking with 4 panelists whose performances in 1999 were downright awe-inspiring about exactly what they expect for 2000. After all, we didn't get to be America's most watched money program by resting on our laurels. Liz Ann Saunders, the market defied all the alleged voices of caution, once again, by ending 1999 with a tremendous surge. Presumably, this can't go on forever. But how far off is that?
I think you mentioned the fact that we're imminently going to hit the point where this is the longest expansion on record, but I think probably most powerful is the fact that that has been combined with record low inflation, and that's really a magical environment for the stock market. And I think as long as inflation remains in check, I think certainly for the year 2000, things look terrific.
John Kim, are you equally euphoric as we enter 2000?
I am. I was more euphoric a month ago. I wish the market, especially the NASDAQ, wouldn't have run up as much as it did over the last 30 days. But I think that, while there might be a mild correction here in the first quarter, that we're going to end the year at higher levels here in all of the major markets.
Don Dessau, should we begin to be worried?
No, Lou, I don't think not yet. I think before we need to worry, we'll have to see growth in the global economy really move ahead sharply. And that's not going to happen this year. I think we will have growth improvement in Asia, in Europe, and continuing in the United States. And so I agree that we'll see a higher market here, and the danger signs are still a ways off.
Laszlo Birinyi, you checked the money coming into the market. Is it going to be good news?
I think it is. I think more importantly, the individual who's been flush with cash continues to have cash and continues to be positive. And he's been a driving force, and I think that will continue for another 12 months.
How about the interest rate question that I mentioned? Is that going to trip us up?
I don't think so. I think the real key to interest rates is expectations. And since there's some expectations of higher rates in the next year, people aren't going to be surprised by them, and therefore they won't hurt the market.
Well, we'll dot the I's and cross the T's as we go along.